Good afternoon. Thanks for joining us for today's healthcare webinar. It's titled Tips to Prepare for a Healthcare Financial Statement Audit. I'm Janice Snyder, Partner and Director of Assurance Services here at McKonly Asbury. I specialize in serving healthcare, nonprofit, and manufacturing clients. I also have here with me Katie Hand. Katie gets to spend a lot of time with me. You love that, don't you, Katie?
You know.
She's smiling. So Katie serves all our healthcare clients in the firm, or almost all of them, spends all her time serving healthcare and loves to do single audits as well in those times. So you get to spend the next hour hearing from Katie and I. So I'm just going to take a moment here. For those of you that don't know a little bit about the firm, McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We provide a range of services, as you see here on your screen, to a variety of industries, and we encourage you to visit our website to learn a little bit more. But we're going to spend our time today on healthcare, which is what Katie and I love to do. So if you've joined us in past webinars, welcome back. If you haven't, we have monthly webinar features. So this month we actually have 2. So we'll tell you more about our upcoming webinar next week at the end of this webinar. So check out our website and catch more webinars in the future. So the first thing we get to do is start off with a polling question. You've got to tell us whether or not you want to receive CPE for today's webinar. So we're going to launch that first polling question here right as we get started. So I think a lot of you do want CPE for this, right, Katie?
Yes.
So make sure you answer this question. So we know that the majority of our audience here are healthcare attendees and a lot of our clients. So we're glad you're here with us today, but I think a lot of you are already pros, but I think you'll still get some tips and takeaways from this. You agree, Katie?
I would agree.
So make sure you answer this. I think you have about 10 more seconds on this, but I know there's just a few of you that are here for the CPE. So hopefully we can keep you engaged and entertained while you earn that CPE this afternoon. So we are on the countdown. 10, 9, 8, 7, 6. Now I think you get the idea. We'll find out quickly who gets their CPE. So, and then I know Katie's going to lead us right into, yes, almost all of you need CPE. And for the few of you that don't, we are even more grateful that you're here this afternoon. So I'm going to let, I'm going to go over quickly the agenda and the key things we're going to cover here today. We're going to talk about your accounts receivable and revenue. It just would not be a healthcare webinar if we did it. So the things that we want to see as your auditors, but the things I'm sure you are already all over these items, but we're going to touch on them anyway. And then key tips for planning and scheduling a successful audit. That's what we all want. We want it to go easy, smoothly. You love to see us come, but you're more happy when we go. We know that. You want to get us in and out, no surprises. That's what we want. That's what you want. We're going to talk about some of the new accounting pronouncements, maybe more a little bit employee retention credits and what that might mean for your audit, and then wrap it up to the extent we have time with some common pitfalls and findings that we see in our healthcare audits. Talk a little bit, a few things specific to for-profit entities and a few things more for nonprofit entities when we get into those pitfalls and findings. So I've just teed that up for you, Katie, but I'm going to turn it over to you to get into some of these details here on accounts receivable and revenue data and reporting.
Yeah, so let's talk about accounts receivable and revenue data and reporting. So have you ever wondered why your auditors focus so much of their attention on testing your accounts receivable and revenue balances? Because we do. We truly do spend so much of our time testing these areas. Well, if you ever were curious as to the why, here's a little bit of a background to understand that. First off, accounts receivable and revenue are pretty complex audit area under US GAAP because they require management to make significant judgments and estimates in the process of applying the accounting guidance. They also impact a number of line items on your financial statements. So of course, your net patient service revenue and accounts receivable balances. There could also be contract assets and liabilities, as well as third-party settlements. If applicable to your organization, grants, contributions, and refundable advances. So those are the key line items that are impacted on the face of your financial statements, but let's also not forget all of the required disclosures that come from revenue receivables, such as your policies, your disaggregation of revenue, and your concentration footnotes. So therefore, your auditors spend so much of their time testing these areas because they pose the highest risk to the fair presentation of your financial statements. Bottom line, it's essentially what all your readers of your financial statements actually care about, so it's very important that you're getting them right.
I mean, most organizations, Katie, revenue is the biggest number.
Correct.
Everyone's going straight to that. Are you growing? Are you shrinking? Like, are you collecting that cash, turning that revenue into cash? I mean, that's what they say, how big is your organization? What they're talking about is revenue, right?
Yep, 100%. So, a question that you may be asking yourself, what the heck are your auditors even looking at when it comes to patient revenue and receivables? So let's talk about some of the key procedures that we perform, because there are quite a number of them. So we review the accounts receivable aging and revenue reports. Given that a small sample will be selected from these reports, we need to verify that these are complete by tracing the balances to the ending trial balance numbers. Speaking of samples, yes, we will definitely be detail testing your patient claims. So we start with intake process by asking for items such as a claim form, your doctor's notes, and/or discharge notes if that's applicable. We also request the payment support, such as the EOB, explanation of benefits, for those that don't know what EOB stands for. And then we trace the total deposit to the bank statements. Sounds like a lot of documentation, right? Well, it is. It's where we spend the most of our time testing because of it. One of our biggest testing areas that gives us the most coverage over your net accounts receivable balance is reviewing management's reserve allowance methodology. So we'll inquire about how management is going about calculating that allowance, and then we'll also review the analysis provided by management. We also do our own independent analysis too. So we'll review subsequent cash receipts collections and compare that to total cash receipts to the current and prior year accounts receivable balance. We also perform various substantive analytics. One of them is what we call a cash to revenue analytic, which is where we compare cash receipts from bank statements to the revenue recognized during the year. This analysis alone just gives us great coverage over almost all of your revenue. And then another key procedure that we perform is control testing over cash receipts and revenue cycle. So we will review your policies and walk through the key controls. The key controls could be performed by physically watching the responsible person perform that control, or obtain the necessary documentation to verify that that control is taking place and being followed. So after understanding the key procedures that your auditors are performing, let's discuss some ways that you can ensure will help with a successful and efficient audit. Janice, if you want to move to the slide.
I wanted to say a few things before you go to the next slide, Katie, because I know in this slide that, you know, cash is king when you think of any organization and how you manage it. But in healthcare, it's one of the few things that you go in and you're receiving a service, and most of the time the patient doesn't know what's going to be paid for that service, either as an individual. We'll talk about self-pay revenue and all that later, but you have either an insurance company, a third-party payer, insurance, Medicare, Medicaid. Someone else is going to end up paying a lot of that bill. You might have a copay or something you have to pay at the end of that service, and we're trying to figure out how much you're going to get paid, and are you going to collect that cash through good processes and good procedures, and you're estimating that. But I've gone to tons of healthcare trainings over the last 20 plus years, and you can sit in rooms with auditors, accountants, your CFOs, your controllers, and they always say, you know, who's responsible for that allowance and making sure the AR is fairly stated? Well, of course, that's management. That is the company. They're responsible for that. But then you can start to get into an interesting debate as the auditors are, you know, testing management's methodology, but then also coming up with their independent estimate as well. And then you're all trying to agree, like, is that estimate reasonable and does it make sense? And is the cash really coming in the door? So it's a little bit of an art, it's a little bit of a science, but I mean, the cash is everything at the end of the day. And so we're not only spending a lot of time testing the claims and the entire process from beginning to end, which is a tremendous amount of detail. we spend an exorbitant amount of time on cash and matching the cash to the revenue and to those receivables, the prior year receivables, the current year receivables. It's a lot, right, Katie?
Yes, 100%.
So I'll let you move on because we could talk about a lot of these things all day. And our clients feel this, like they know this is what we do, but we spend a lot of time on this.
Oh. All right.
I almost jumped you too far ahead there. Let's do it right here.
All right. So what do we need from you in order for the audit to be successful and efficient? So let's first talk about the auditor work paper testing area. We love when clients provide everything to us that is well organized and wrapped up in a tight little red bow. What does that even mean? Well, that means that all support provided is double checked, that everything is complete and accurate, and that all reports are reconciled to the trial balance. This includes, but it does not limit it to just the accounts receivable aging report, the detailed revenue report, and the reserve methodology report, AKA the documents that support our key procedures over revenue and receivables. We also need the revenue and accounts receivable reports to be ran at year end. That includes detail level line items. So this includes some type of patient indicator, such as a patient ID number. We prefer not to have names, but if that is the only option, it's not the end of the world. We would just delete the names out right before we final issue the financial statements. In these reports, we also need to see dates of service and the charge amounts. But it's also nice when these reports have payments and adjustments in them, but it's not completely necessary. It just makes our lives a little easier when we're going about our testing. As I mentioned before, one of our biggest testing areas is looking at subsequent cash receipts. So therefore, we need a detailed report for those cash receipts that includes a patient ID, a date of service, a date of deposit, and the deposit amount. We love when the patient claim sample support is organized and documented with comments of unique scenarios, or if management already knows support is missing, to let us know upfront. As I mentioned, this is where we spend a significant amount of our time testing because of how much documentation is involved. So if you can provide it well organized, it just helps us out tremendously. So how do we like support provided to us? Well, we prefer support to be provided by either the patient ID or providing the support by request. So for instance, we request the claim form, provide all the claim forms in one file. But if we had a choice between those two options, we would definitely prefer the documentation to be provided by the patient being sampled. For the control testing piece, just make sure that you have and are frequently reviewing a written cash receipt and revenue control policy for us to follow.
So I think there's a lot here, Katie, that is like, how would we like to see it? Well, I don't think it's just about us. We could deal with a lot of things, and we do. But when your records tie out and your records are clean and your trial balance ties to your underlying report, that makes it easier when government agencies come in and conduct their audits. If you have an internal audit department that's doing their audits, it makes it easier to support the numbers that you're recording in your financial statements. If you happen to get audited by recovery audit contractors that are coming in, other agencies that are coming in, I mean, it's not all about us, right? We want to make it easier for management, for the organization, for your jobs to be replicated. Yes, it would make our lives easier, but it makes your lives easier when these things are organized, readily accessible. Like, there's a huge benefit and value to management if these things are all put in a set format that's readily accessible, easily tied out. Good electronic medical records help with that, but this goes so much further to get to the cash receipts and to pull the whole process together. So yes, we like this, but management should like this too. Like, and individuals that are reviewing it, it helps through your claims denial process, through your follow-up process. At the end of the day, good documentation and good records gets you more money and gets you paid better. So these aren't just good things for your auditor, it's good things for the organization. So that's good to keep in mind as well.
Yeah. So then let's talk about what are some key items we need for your disclosure support. you want to move to the next slide. So we will need a report that is by payer for both net revenue and net accounts receivable balances. So this is your concentration footnote. And the key here is just to make sure that these reports are tying out to the trial balance. We also need a report on how management would like revenue to be disaggregated, so such as payer. If that is the case, if you're disaggregating your revenue by payer, you don't need to provide a separate report because we already have that from the concentration footnote. We've also seen it disaggregated by location or by service type or revenue recognition. Again, it depends on how management wants to disaggregate their revenue. This also needs to tie to net revenue per the trial balance. So the key here, making sure all of your reports are tying back to your trial balance amounts.
And it's nice that these standards for these disclosures allow you to present this in your financial statements the way management's already supposed to be reviewing it. So you can do by location, you can do by service, you can do by payer, you have some flexibility for that disaggregation. So we're not telling you exactly how you have to do that, but you are right. The information does need to agree to what is on the face of your income statement or statement of changes in net assets or whatever you call that for the type of organization that you are.
Yep. And then if this applies to your organization, if you are required to provide charity care, we would, for support for your footnote, we would just need your updated charity care policy and then the cost amount provided during the year that relates to that charity care.
Yeah, and the most important thing with charity care is that you're determining it at the time you see the patient, not later, not after the fact, not instead of right off of AR. You have to be determining that up front.
Yep. All right. So that concludes the discussion over accounts receivable and revenue data reporting, which then brings us to our next polling question.
See, Katie, you make that almost sound too simple. We know it's not.
That is it. That's all you have to do for us in order to have a successful audit. That's the polling question number 2, I think, is popping up. Yep.
There we go.
So my organization represents which of the following groups?
Yeah, we're curious. I mean, we saw the attendee list, but who's showing up here today? And maybe we can tailor some of the discussion on the back half of the webinar to who's with us today. So how many for-profit healthcare organizations, nonprofit healthcare organizations, and individuals like us, the accountants, consultants, government agencies? We know there's some of them signed up today, and maybe those that fall into the other bucket. So let's find out the spread here. So we have 10 more seconds. Don't forget to answer the question.
So you're going to do the countdown again, Janice.
Okay, we're probably 5, 4, 3, 2, 1. I thought some silence might have gotten their attention on this one, so that's what I was going for. So we have a nice spread here: for-profit entities, nonprofit entities, accountants, governments, consultants. So that's a very good thing. Maybe some of our teams here are listening, Katie. I think that's might be what the accountants are. So some of our McKonly and Asbury folks, I know they were going to listen. So we're glad you're here. All right.
All right. So the next topic, key tips for planning and scheduling a successful audit. So the next 3 slides, I am going to talk about what I will call the 3 Bs. Be proactive, be prepared, and be available in order to help have a successful audit. So the first B, be proactive. Stay in communication with your auditors all year round. If you come across a unique scenario that you just aren't sure what the best accounting treatment should be, by all means, reach out to your auditors to discuss. I promise you they will be more than willing to help guide you and provide you with research on how to account for those unique situations. Believe it or not, we actually enjoy having these conversations because we get to do some research and most of the time learn something new. Also inform your auditors when you're going through significant changes such as a system change, entering new debt, discontinued operations, etc. That way, 1, we are informed and not surprised during the audit. We don't like being surprised, so please don't do that to us. But 2, informing you with reports we may need that you aren't thinking about obtaining, and or 3, helping you with how to account for such items if needed. So bottom line, reach out to us all year round. We love hearing from you, and we are happy to help.
Sure, we're going to reach out to you. We enjoy that part of our job, like in the middle of the year, what's going on, tell us what's different, tell us what's new. But it's much better to talk about something in the middle of the year when you're all a little more relaxed. Well, we're busy year round, no matter what profession you're in. We know that these days. But when you have a little more time to plan and prepare and discuss those sorts of things, then it's much better. Maybe you did an acquisition, maybe there's a merger, maybe something, you're acquiring something, a building or a new lease, or you're making some decisions there. We'd much rather talk about it sooner and have you get it right the first time than have us find something later. Finding something later is the worst possible situation you could be in. You could end up with audit findings or audit adjustments or material weaknesses or significant deficiencies, the kind of things that you don't want, the kind of things that make our jobs more difficult. It's our job to find things when they're wrong, but we would just rather they not be wrong. Like, that makes everybody's life better. Like,
yeah. So the next topic, like, be proactive with the prior year recommendations that were provided from your auditors. If you were provided any, there could be a chance you didn't have any recommendations, but just ensure that if you do, get them resolved in the upcoming year so they aren't recommendations again. Also be proactive in reviewing all of your policies and procedures to ensure what is noted in them is what is being performed. Like I said, we do control testing, so we're walking through a control that doesn't even apply anymore. Well, then you're going to get a recommendation from that. Update your policies. So be proactive and get them resolved beforehand. Lastly, ensure that all your adjustments from the prior year audit have been recorded. When they aren't made, it makes your auditor's life a little more challenging because your opening balances are not matching the prior audited financial statements, which causes equity, net assets to not roll forward.
it also means the numbers that management and the board or anyone has been looking at throughout the year are not accurate.
Yep.
It means everything that's going forward and what you're making decisions on for the whole year have not been correct. So, there's a part of it, we're seeing it from the auditor side, but there's a management side of that as well. Like, I sit on boards that you want that information throughout the year to be accurate as well. So that should be part of the process of ending the prior year audit, of making sure anything that was captured as part of the audit gets recorded. But certainly before you get into the following year's audit, you should make sure that you should double check and make sure that that has been done.
Yep. All right, the next B, be prepared. So during month-end closing, ensure that all your reconciliations are tying out to your trial balance. There you again, tying out to your trial balance, as well as proof that those reconciliations are being reviewed and approved. The review and approval process can be performed as a checklist sign-off, an email approval, or even a sign-off on the reconciliation itself. The physical review and approval over reconciliations not being performed is probably one of the most common recommendations that come from an audit. The review and approval may have been done verbally, but if your auditor does not see physical proof of it happening, it just didn't happen. So just make sure that there is some type of physical proof taking place. Your auditor should be providing you with their request list in advance. So just make sure once you are provided that request list, you're taking a look at it and you're reviewing it and ensuring that you have all the documentation available and gathered for the upcoming audit. It just makes your life a little bit easier going forward so you're not scrambling and finding things.
I know we like to have a meeting to review that list, make sure you understand what we're asking for, avoid any miscommunications there. If everyone's on the same page, that makes it so much better. That way you're not sending something and we're like, well, that's not quite right. Or, and we don't have to go back and forth as much. If we all get it right the first time, that makes management's life so much better. We don't have to ask for something again.
Yep. So if your systems are live, meaning you aren't able to backdate to a certain time period after the fact, just ensure that you are running those detail level reports that I mentioned earlier at the year end so that they're tying to your trial balances. There's times where we come across reports that were ran 3 months afterwards, but they're not tying to your accounts receivable because your reports are live. So just make sure you're running those reports timely.
Yeah, these system limitations are a huge challenge, and it's surprising some of the systems that are out there that still function and operate this way. And a lot of organizations have moved away from them because they are so challenging. But they still exist at some places and within some organizations. And if your organization works that way, we just cannot emphasize run more than you need, get more detail than you think you need. Just make sure you have that information. If you do have those live systems, because it's very, very challenging to go back and get that.
Yep.
Or if you change systems, that's very challenging. Again, talk to your auditors about that well ahead of time and make sure you're getting all that information for the cutover and access to the old information.
Yep. So the last point on this slide, so if you are aware of any unique scenarios of why accounts have fluctuated from year over year, sure enough, if they are large enough swings, your auditors are going to ask about them. So to save some time on that back and forth between you and your auditors, let them know ahead of time by typing something up and posting it to the request list. They will definitely thank you for it. All right, so the last B, be available. It is very important to meet with your auditors way before preliminary and final field work from taking place to lock down dates and everyone's schedules that work for everyone, as well as those financial statement deadlines. This would also include the board meeting dates that you would like us to present at. Unfortunately for you, but fortunately for us, you are not your auditor's only client. So when an agreed upon timeline is not followed due to not being ready or being unavailable, there could be risk that the audit does not get completed by the deadline. And trust me, we never, ever want that happening for our clients. So please, please, please ensure that those dates are locked down. And if something does happen before preliminary or final field work takes place, reach out to your auditors in advance so that they can hopefully reschedule when that work can be performed. Ensure that team members that will be part of the audit knows the timeline and understands their roles and responsibilities to fulfill audit requests timely. So when there are many individuals that have access to the audit request list, there may be some confusion as to who owes us what, and then cause some delays on getting that information to your auditors. So just make sure you're just staying on top of that by assigning the tasks to the correct individuals. And then also ensure that during the preliminary and final field work that the key individuals, AKA your auditor's main contacts, are available to discuss matters on a daily basis if needed, if things come up throughout the audit, so we can get our questions resolved timely.
Sure. And we love to know people's schedules and what's going on. Like, hey, this person's processing payroll these 2 days and you might have questions. Don't talk to them these 2 days. Great. We're perfectly comfortable working around that. The more we know, or hey, this person doesn't work Wednesdays and Fridays. They work Monday, Tuesday, Thursday. Great. We're going to work with that. The more we know, the more we can plan. But that helps you too, because we're not going to someone on their day off or sending them, 10 questions that day or trying to schedule something. And then lots of people can get frustrated. We're happy to work around that or anything like that. So please just let us know. But the more communication, the better.
Yep. So in order to plan and have a successful audit, make sure to be proactive, be prepared, and be available, which concludes this discussion of key tips for planning and scheduling a successful audit. And then also
it sounds so easy, Katie, but it's not like everyone doesn't already have full-time jobs, right?
I know. We just
it's so difficult to fit all this in. It sounds great, but we know the challenges and pressure that everyone is under. But I think you were ready to move into the next polling question.
Into the next polling question. So what is the biggest challenge you face when preparing for an audit? Hopefully it's the last one. Our audits always run smooth.
All right, go ahead. What is the biggest challenge you face? I think you touched on a lot of these things, Katie. So I'll be interested to hear what everyone says, because we got for-profits, nonprofits, and I think we got a lot of auditors on this call too. So I want to hear what they have to say as well. Everyone's going to say they run smoothly because they know exactly.
That's what I was saying. I hope that is the case.
We do have individuals asking for handouts. Our slides are the primary handout. So we do know that the slides will be available and can be downloaded if anyone would like them as well. So we'll make sure that you can get them. I don't know if they're available right now or if you can download them during our presentation. So make sure you're answering this polling question, but the slides are available in the chat. So if you're having any trouble with that, just let us know. So Katie, look, I love that. 26% say their audits always run smooth. That's fantastic. So, but we do see challenges preparing the necessary year-end schedule. So that, I believe that is additional workload, additional volume. So there always are. It'd be interesting to know more. So is it really the samples that we're picking? Because a lot of the reconciliations, the review, those sorts of things should just be part of the monthly process.
Yep.
And I do know the questions we ask, the samples we're picking, the additional documentation, I can see that adding an additional burden.
Documentation.
Any thoughts on that, Katie?
Yeah, I just said, like, it is a lot of documentation. So I have a feeling for the samples, I have a feeling that might be the case, because yes, reconciliation should already be part of your month-end closing process.
Mm-hmm. Yeah, we're difficult. We know that. We try to be pleasant.
You're very thankful for you guys. You already do.
So we're moving on to new accounting pronouncements. I guess the good news is that there's not a lot, so that's great, because the last few years have been a whirlwind. I feel like I should have just stayed on this slide. We have survived revenue recognition. Leasing, that is behind us at this point. At least we're into year 2 at this point for everyone on this call. Revenue recognition, leasing, and we got through all of the crazy amounts of COVID funding, which was fantastic and amazing. Still have a little bit of things we're talking about here with that. But between the PPP loans and all of the crazy amount of healthcare funding that came through and a new type of funding, it was great cash flow to keep everyone going during the challenges that existed. But the accounting pronouncements have slowed down, and I must say that I'm grateful for that. So we just have 2 topics to talk about here with new accounting pronouncement. And the first one is the hot topic of credit losses, or as some people say, current and expected credit losses, or the acronym for that is, a lot of people say, CECL. So in the financial services industry, CECL has been huge and has been huge for years. I think this standard was written in 2016, and it started becoming effective for public companies 3 or 4 years after that, and is effective now for private companies, effective 1/1/2023. And so it is coming effective now for the 2023 year ends, and will be affecting nonprofits for their 6/30/2024 year ends. So what does it affect? Trade receivables, loan receivables, certain types of investments in sales and direct financing type leases. You'll have to look at the financial statements and say, how should we be looking at these current and expected credit losses? For a lot of organizations, you're going to think of this as your allowance for doubtful accounts is what it used to be. I think this might be the next slide. Or your provision for bad debts, those sorts of things. They're now going to call that a provision for credit losses or provision for uncollectible accounts. What this standard does is it's not only looking at like certain calculations for what would have been bad debts, it's looking at not only your current but expected credit losses. So it is a little bit more forward looking. The financial services industry, this is creating some larger losses that are being recorded sooner. When we look to healthcare industries, you're looking at your net patient service revenue, but really the receivable side. You already have very large allowances on a lot of your books, whether you call them contractual allowances or you call them bad debt allowances. So this is really focused on what would have been the bad debt allowances. So as a lot of you went through revenue recognition and said, for this really comes down to your self-pay patients. And the first step was, did I or don't I have revenue under the revenue recognition standard? And the first thing they said, if you have a self-pay patient and you're not assessing intent and ability to pay, you really don't have revenue from a self-pay payer until they pay you. So for most healthcare organizations, this is pretty immaterial. So you had self-pay revenue, but it really doesn't matter compared to all of your revenue. It's a pretty small number. So, but technically you shouldn't record that revenue until you were collecting it, unless you were doing credit checks and assessing intent and ability to pay. It was not material. Most organizations didn't really change the way they were doing that. Very small number, almost fully reserved. That remains the same when it comes to revenue recognition. But if you are going through some of our payers, our federally qualified health centers or things like that, some of our clients are assessing a patient's intent and ability to pay. And instead of having an allowance for bad debts or uncollectible accounts, you may now have a provision for credit losses or an allowance for uncollectible accounts. You may still need to look at other notes receivable or things like that. For the most part, I don't want to downplay the standard, but for the most part, it's going to be a change in terminology on your financial statements as opposed to any significant dollar impact on the financial statements. Again, large company, large amounts of investments, notes receivables, you might have something a little bit different, but for the average healthcare organization, some change in terminology is going to be the main impact of that. So we can't not mention it. So I just wanted to put that out there, a little bit of change in disclosures in your financial statements. If you have other things, we're happy to go down the rabbit hole with you and make sure we're properly addressing that. Right, Katie?
Yeah, the only thing I would like to add, because I know that you and I had discussions back and forth about contributions. So for our not-for-profit organizations, contributions do not fall into the scope of ASC 326. Just throwing it out there.
They're not part of credit losses.
Yes.
So it does not affect your pledges receivables, right?
Yeah.
Yep. So good point, Katie. I was not thinking about that side of it, but you are correct.
Yep.
So, all right, we will move on from credit losses. So we had a lot of the COVID funding behind us, but employee retention credits are still being discussed quite a bit. And they're still making the news and they're making the headlines as the IRS continues to extend their statute of limitations. And they're still going back to organizations and saying, are you really sure you should have applied to this? And oh, by the way, if you're not sure, you have a chance up until March 22nd to give some of that money back and take a look at your calculations. So certainly a lot still going on the employee retention credit side. But we're going to talk about the accounting for employee retention credits. As you look at your financial statements, so you've gone ahead, your organization has done the calculations, you have qualified for this credit, lots of things to consider there, especially if you're a nonprofit organization that gets a lot of other federal funding and grants. You've had a lot to consider to make sure you're not double counting that federal funding and double dipping, and there's a lot of complexities, not only in the ERC calculation, but your follow-up steps beyond that to make sure you didn't double count any of those federal funds. So you've gotten through all that, you've applied, you submitted your applications. Now what? Where are you in that process? And when do you recognize revenue? Do you have deferred revenue? Do you have liabilities? It's all just as clear as can be, right, Katie?
Oh yeah, let me tell you.
So there's a lot of guidance out there. We're going to touch base on it rather quickly, but we certainly had discussions with many of our clients. And we can say that most organizations are deferring the recognition of this, and that is appropriate for a very long time under some gain contingency guidance. So we're going to talk about using nonprofit guidance for under revenue recognition, so you could follow that standard. We're going to talk about some of them following the International Accounting Standards Guidance 20 for government grants. That is one of the ways to recognize revenue the fastest and one of the more aggressive ways. And then the gain contingency model, which has you deferring it the longest. All of these can have you deferring all the way until the statute of limitations expires by the IRS and their right to audit you. So that's sort of the conclusion of all of this, but we're going to walk through each one of these. So nonprofit entities and revenue recognition. I think the important thing to say here is this isn't limited to just nonprofit entities. When a lot of the grants came out and PPP loans and the ways you had to kind of pull parallels from different standards with new types of funding and sources, you could draw parallels and adopt these as your policies. And a lot of people did pull from different standards, like US GAAP doesn't follow international standards, but you could liken it to the international standards. So this is one method in accounting for your employee retention credit to follow the revenue recognition model for not-for-profit entities. So revenue is recognized when the conditions have been substantially met. So you've met the conditions of the employee retention credit, you've done your calculations, you've submitted your application. So you've met those conditions, you said we're comfortable with that as an organization. And then a second piece of that, or things have explicitly been waived by the donor. In this case, they would say the donor is the federal government. So then you're looking to, has the statute of limitations expired on the IRS side of when they could come back and recoup or audit those funds. So you're sort of looking at those two pieces and saying, do I recognize revenue when I believe we've met all these requirements? And some organizations are saying I met it when I get the money, and others are saying I don't think I fully met it until the statute of limitations expires of when the IRS says they have the ability, they no longer have the ability to audit and come back and recoup those funds. Anything you want to add on that, Katie? It's a mouthful.
Yeah, I would also say, like, with substantially met, you could also potentially recognize the revenue when you meet the criteria of the ERC credit. So like you lost revenue, you've already paid for those payroll taxes back in 2020, 2021 timeframe. So you could argue that you could recognize revenue, but again, that waived by donor. The conservative approach is to wait until the statute of limitations has been lifted.
Yeah, a lot of judgment in selecting these, which methods you're going to follow. So the next one is available, the International Accounting Standards. This could be the most aggressive. They tend to be on the International Accounting Standards side. So this threshold is lower. It's a reasonable assurance threshold so that the entity will comply with the conditions and receive the grant. So this is more, you've run the calculations, you're comfortable with them, you've either probably haven't gotten the money yet, but you've submitted your application, you feel confident that you've met them. So you do have a little more flexibility and latitude under this model. A more conservative approach is still to wait to record your revenue until the statute of limitations has expired, but this is a longer runway with more flexibility about when you would record the revenue. A lot more judgment in this one, which is generally true anytime you're following an international standard, much more principles-based, less rules-based. And the last option is the gain contingency model. So it's when all related contingencies have been met and the gain is realized or realizable. So this one, you do have to have the cash in your bank account without any expectation of repayment or refunding of that cash. So this is the most conservative. You could get to the same accounting under the other rules if you choose to wait. But the gain contingency model says we have to be virtually assured that we're not going to have to repay these funds. And we do have a number of organizations that they were confident in submitting their application. They are confident in the organizations they hired to support them with that process. Management has reviewed it. Management ultimately is responsible for that. They have some of the millions of dollars in their bank accounts, and they're not recording the revenue until the statute of limitations have expired, and we've modeled that out, and that's a lot of them in 24, 25, or 27, and we've looked at that, but now the IRS seems to be extending that time frame, and so some of this revenue could be recognized out 5, 6, 7 years from now, depending on when that statute of limitations expires and where that sits with the IRS. So just very interesting times as we're following these standards and how they continue to evolve. I guess it's risky when you're taking all of when you're applying for all of these, and appropriately so, as you should be, but these are all, risky accounting, risky propositions. So you just have to be confident in what you're doing and the positions that you're taking. All right. So common pitfalls and findings as we wrap it up in the last 10 minutes here. So I'm sure Katie will love to weigh in a bunch on these. So what do we find the most in an audit? The biggest one, the reserve on your accounts receivable. Is that reasonably estimated? The most common thing we find is you're not collecting your cash. We have turnover in the medical billing office, an intake for not getting all the right information, the notes in our files and that we're taking in our electronic medical records. Our training isn't good enough, that we're just not collecting the cash because somewhere in the whole process, some step isn't functioning as well as it potentially could be. So somewhere, something isn't going as well as it could, and we're not getting the cash in the door to collect what we probably should be collecting, right? And then you have smaller claims that just the follow-up process, you submit them 1, 2, 3 times through your claims denial process, and eventually you're just not getting paid on that, and you hit the expiration date 180 days out, and that payer's not going to pay you for that. So there is a point where you're not going to get paid, and we're trying to figure out, are your accounts receivable adequately reserved? That's more complex at some organizations than others, and you get workers' comp claims where you could be paid 3 years later, and you're just not sure, but you're trying to estimate those sorts of things. That's our biggest audit adjustment by far, right, Katie?
Significant deficiencies, that's the area where that comes from most of the time.
The other thing that goes hand in hand with that is patient claims documentation not kept on file. And a lot of that is patient intake forms or or admission forms, things like that. So you have the record that the patient was there, they showed up for their visit. Like, it's a lot of electronic medical records that can help with that, but sometimes it's just missing. Accounts receivable balance is not reconciled to the AR aging report. So there's all kinds of reasons that can happen, from cutoff issues to live systems to wrong dates of, you have payment dates versus service dates, and things get messed up in the systems and things just don't agree, and then you end up with all these cutoff issues. And you're like, well, how many days could we be off? 3 days, 5 days? What does that look like? How do we get comfortable with that? We could go on for that one quite a bit. It just starts to get so challenging. Was last year off? Now is this year off? Like, how did this happen? Like, is it going to be wrong next year? Like, it just starts to go on and on. I feel like I should breathe. It goes hand in hand with those cutoff issues, though, on the cash posted report, because you need a good cutoff date for those date of services, right? It's a lot easier when you see 1 patient per day per visit. It's a little bit more challenging if you have patients in-house or patients you see for multiple days, inpatient stays, those cutoff issues. And then when you get cash payments, or you have cash suspense accounts and all the cash isn't getting posted timely, or so you have turnover and someone's not posting all of your cash. And you're like, oh, what is this hundreds of thousands of dollars sitting here? And then you're not sure who it applies to and where it goes. And cleaning things like that up are certainly challenges, findings, pitfalls in a healthcare audit specifically. So yeah. I know the next 2 slides, they tie into healthcare, but aren't as specific as to why revenue and receivables. We spend so much time on it. We spend so much effort, so much judgment in the revenue and receivables process. Anything else there, Katie, before I move on?
Nope, I think you covered it.
Everyone on this webinar, they live it. So I think they know. I think all these details matter. Next one, subsequent cash receipts do not support the receivable balance. So again, they're all tying together similar issues, but any one of these can lead us to, is your revenue or your receivables properly stated during the period that's being audited? Another challenging one is lack of support for third-party payer liabilities. So some organizations, you have turnover or you have this history or some liability that's been sitting out there for 2, 3, 10 years, and they're at the point that no one really knows what it is. You have the same audit firm that they may know, but maybe management doesn't, or auditors turnover. We come into some organizations new and you're like, so what is this couple $100,000 sitting there? And no one really knows or understands that. Keeping support for that documentation, what is it? Who might you owe it to? Why was it sitting there in the first place? when could we potentially reverse this, who would we owe it to and why, is just really important. So trying to stay on top of that is an important thing to do. Another one that's not necessarily unique to healthcare, but we certainly see it in healthcare and other organizations, is failed debt covenant requirements. It's the worst when management doesn't know they're going to fail, or they don't know that it's going to be close, and it comes up through the audit process. You certainly want to be in front of that, at least if you don't have to calculate them quarterly, maybe you should anyway, so you know what's coming, or at least be doing pro formas near year end so that you can be in front of your banks trying to get that waiver, being proactive with them, knowing when you're going to be back in compliance or when you think you will. Because last minute and surprises, banks don't like that either. Your board or your owners aren't going to like that. Whoever it is, nobody likes those surprises, and being in front of that is going to make the conversation so much better. And another one is the reconciliation of inter-entity or intercompany or related party accounts. That's something that can be challenging from time to time. Who do you owe this to? Why do you owe it? I've seen many issues with that over the years, or something that can often just be missed. So certainly can happen in our healthcare clients. These can happen at any company. So Katie and I could go on story time for lots of these, but we won't. Not in our last few minutes here. So on our last slide on common pitfalls, I wanted to just take a moment to focus on some things specific to nonprofit healthcare organization. So improper tracking of restrictions on net assets. We've picked up many nonprofit organization clients, healthcare clients, when there's restricted net assets, and the history on those. Are they restricted in perpetuity? Who restricted them? How did they restrict them? What was the original amount of the gift? Sometimes these gifts can go back 20, 50 years. The sooner you try to create records on that, the better. Like, waiting will never help. The sooner the better. If you're a federally qualified health center, I've never met with one that isn't concerned about their sliding fee scale. If you don't know what that is, you are so fortunate. Those of you that do, let's talk. And the ability to verify income for all of those individuals that qualify for the sliding fee scale. It's such an important aspect of being a federally qualified health center. We welcome that conversation any day. But understanding and the proper use of grant funds. So how do you use them? What are the strings attached? This happened not only to nonprofits, but to a lot of for-profit healthcare during COVID. They had money dropped into their bank accounts. Some of you, hundreds of thousands or millions of dollars. Where did it come from? Who gave me this money? What are the strings attached? How do I keep it? What does it require me to do? So a lot of you experience that, even if you're not a nonprofit organization. But making sure you have a really good handle on all of that is so important. And then for nonprofits, unrelated business income and the tax consequences of that, and the filings that you need to do and how you need to report that. And the last piece, if you do need a single audit, the timely filing of the data collection form. So these are the things that are going to trip up. I guess that did tie in a little bit of for-profit issues there, but they generally are unique to nonprofits.
Yeah. I would say also, we mentioned like the reserve analysis is probably where material weakness, significant deficiency comes from when you're going through an audit. But for non-for-profits that are FQHCs, sliding fee scale issues is where the other issue that can come from material weakness, significant deficiencies.
Yeah, they're definitely the two most common.
Yeah.
So. This takes us to our last polling question. Those of you that hung on, you'll get your last one here. So the topic that was most helpful in today's webinar, this could really help us with future planning, but we know we're going to survey you at the end as well. So we love to hear that, so we can try and make future webinars really beneficial to you. Katie and I do this like at least once a year, twice a year if you have really good topics for us. So we would love that. The topic that was the most helpful in today's webinar was Katie talking to us all about accounts receivable and revenue data and reporting, key tips for planning and scheduling a successful audit. You're all great at that. We heard that. So new accounting pronouncements impacting the audit. So there's not too much. I'm really happy about that. Or the common pitfalls and findings. So I think 5 more seconds. 4, 3, 2. Don't forget to answer this question. About to wrap it up. I do want to see this.
Oh
my gosh.
Red.
That is pretty evenly
like
spread. I don't know if that just means we picked really good topics or nothing really resonated. I'm going to go with really good topics. So.
I like it. I like that answer.
Interpret the results. So hopefully your comments will help us understand. But it sounds like a good spread. So hopefully everybody had some good takeaway today. So I know Katie and I enjoyed it. There's our pictures again. So hopefully you all enjoyed it here with us today. So you're welcome to submit questions. You're obviously welcome to contact Katie and I directly. We would love that. We love to talk all things healthcare. So we could tell you stories. We could have lunch. We would have lots of fun with that. So just reach out. Let us know. Here's our email. We'll leave it up there for a moment. It's a little odd to sit here and stare at our own pictures.
A little bit.
It is, yeah. But in case you want to email us, please do so. So while that is up there, thank you all for joining us for today's webinar. If you have any further questions, we already said it, please reach out to us. Katie and I would love to talk healthcare with you some more. A recording of today's presentation will be posted on our website and social media sites in a few days. For those of you who requested CPE, I remember that was 97% of you. So if you answered at least 3 of the 4 polling questions, you'll get those certificates within the next 2 weeks. So we hope you enjoyed it. We'll love your questions. I don't think we got any today, but we would have loved to have answered them. And we're going to move forward to our upcoming events. Register today. So we have an internal audit webinar coming up on February 29th. So they're going to talk about external quality assessments and the new standards. So provide an overview of the Institute of Internal Auditors External Quality Assessment and the Quality Assurance Improvement Program that they have. So that should be very helpful. And then I'm looking forward to on May 2nd, Katie and I will be there. Our Firms Collaborate Conference. It's our 10th annual leadership conference. We have some excellent keynote speakers, so we hope that you can join us. Thanks again for joining us and enjoy the rest of your day.
Thank you, everyone.